Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. This week was packed with several key data, and I reckon it's fair to say they didn't disappoint. The recovery in risk assets continued this week as the inflation sustained expectations of Fed rate cuts, while retail sales and labor data raised hope of an economic soft landing. With global equities clawing back almost all of early August downturn, is it too late to enter the markets? To discuss this and more, I've invited Rajat Bhattacharya, our senior investment strategist here at the CIO office. Hi Rajat. Let's start with a recap of the past week. Can you run us through the key takeaways from this week's macro data?
Hi, John. Good to be here. Sure, let's take the recent batch of data, which have been critical in the recovery in risk assets from early August sell off. As we reiterated through the market dislocation earlier this month, the Fed's capacity to significantly ease policy was our main reason to stay invested in a moderately pro risk diversified allocation. The continued softening of US inflation in July provided yet another signal for the Fed to start easing from September, while the strong retail sales data and lower weekly jobless claims boosted hopes for an economic soft landing. This and the near exhaustion of the unwinding of the yen funded carry trades has helped risk assets recover from the recent shakeout. Now let's look at the US inflation report more closely. Both producer and consumer inflation continued to cool in July. On a 3 month annualized basis, core and supercore inflation, by supercore I mean services inflation excluding food, energy, and shelter, have fallen below the Fed's 2% overall inflation target. Although shelter inflation climbed to 0.4% month on month, accounting for most of the July's 0.2% month on month inflation, and auto insurance accelerated, falling market rents and slowing job market portends lower official shelter inflation in the coming months. Also, the sharp drop in used car prices points to lower auto insurance inflation later this year. Meanwhile, the strong retail sales numbers suggest consumers are still willing to spend despite a slowing job market.
What does the latest batch of data mean for the Fed and what does it mean for the bond
Yeah, the
markets?
cooling inflation and surprisingly weaker than expected monthly employment report for July, which came a few weeks earlier, against the backdrop of still solid consumption, have really turned the spotlight on the Fed's annual Jackson Hole Summit, which comes up next week. While the markets are pricing almost 100 basis points of Fed rate cuts this year, starting in September, and a total of about 180 basis points of cuts in the next 12 months, they have dialed back the expected size of the first rate cut in September to 25 basis points after earlier pricing almost 50 basis points of cuts. Our base case remains 2 to 25 basis points of cuts this year, but the risk, I must say, of at least one more 25 basis points of cut has risen after the latest round of inflation and monthly employment report. Now, the Fed policymakers will get a chance to push back against such aggressive rate cut expectations, which are there in the market, which in turn could drive the 10-year US government bond yield above 4%. On the other hand, support for more aggressive cuts could drive yields towards early August closing low just below 3.8%. That 3.8% has not been sustainably breached yet. It's an important support level for the yield, for the 10-year yield. We see low chances of the latter happening in the near term unless the job market cracks and weekly jobless claims surge. Nevertheless, we believe investors have an opportunity to lock in high quality US government bonds for the longer term at 10-year yields of 4% or higher as the US economy gradually slows.
Going back to the question I asked in the intro, can investors still buy into equities? If yes, what are the opportunities?
Yes, we remain modestly pro risk and pro equities in our foundation asset allocation. The VIX index, which is the short term volatility indicator for US equities, has dropped to 15 from above 65 levels at the peak of the market sell off earlier this month, which suggests that investor concerns are easing. Now, granted, there are still risks from any forced liquidation of global risk assets. However, we believe it is time for investors to gradually scale into attractive areas in equities. Within equities, we really like US equities, and in particular, we believe the high growth US technology and communication services sectors remain attractive relative to the other US sectors, especially because of the sector's strong structural earnings growth potential in times with this development in AI. For instance, the market consensus expects 18% and 21% growth in technology sector earnings in 2024 and 2025. Now, over the last 10 years, the US technology and communication services sectors have rebounded the most after the market sell offs amongst all other US equity sectors. Technically, we believe it is attractive to scale into these sectors when NASDAQ 100 index is trading between the double bottom support level at 18,000 and the current level just above 19,000. Moreover, the recent set of data releases have nearly cemented the beginning of a Fed rate cut cycle starting from September, which should support US equities, especially these growth sectors.
The other notable headline this week is a renewed geopolitical tension, specifically in Middle East and Europe. How would that affect our views on commodities?
Yes, the renewed geopolitical tensions you mentioned in the Middle East and Europe, in Europe specifically, Russia versus Ukraine, have reignited concerns about supply disruptions, adding geopolitical risk premium to the oil price, which topped $80 per barrel last week. That is the WTI price. Gold also benefited from the safe haven demand, rising to a new record high on Monday. Now, how long the risk premium lasts depends on whether there is any oil and gas supply disruption. In Europe, the risks of supply disruption rises from the fact that latest Russia-Ukraine conflict is taking place near a key cross-border transit point for natural gas. While there could be a second-order effect, it is likely to be marginal in our view. Now, news reports also indicate that both countries intend to keep the pipeline gas flowing to Europe. In the Middle East, the US has increased its military presence in the region in anticipation of an escalation in tensions. Our base case remains the conflict will be contained, limiting any supply disruptions of oil. Add in the fact that the OPEC's highs spare capacity, which is around about 4% of world oil production, this suggests that the upside to oil prices will be limited. Having said that, near-term volatility is likely to remain elevated. In terms of gold, it has been trading within the range of 2350 to 2480 since July. However, if fresh geopolitical risks emerge, we could see a breakout above this range, potentially pushing gold towards the next resistance at around 2580. Now, we believe it is prudent to maintain some small exposure to gold and energy equities as hedges against the tail risk of geopolitics, especially on any pullback, which is why we maintain a benchmark allocation to gold in our overall diversified asset allocation.
Well, let's talk about FX, right? Specifically the New Zealand dollars. The cut from RBNZ that caught the markets by surprise.
Yes, we do see some downside risks for the New Zealand dollar after the RBNZ cut the interest rates, as you mentioned, by 25 basis points. Now, the move was unexpected, especially with the central bank previously signaling a pause in rate adjustments. The rate cut indicates the RBNZ's growing concerns about New Zealand's economic outlook. Now, in our opinion, the outlook is quite mixed, with soft business confidence and a cooling housing market balanced against a resilient labor market. Additionally, New Zealand's export driven economy has been impacted by softer demand from China, its largest trading partner. The ongoing challenges in China's economy have reduced demand for New Zealand's farm related exports, which are likely to further undermine the New Zealand dollar. Meanwhile, a further escalation in either the Middle East or in Eastern Europe would likely support the rebound of the dollar, acting as a headwind for the New Zealand dollar, which is seen as a pro-risk currency. Hence, we expect the New Zealand dollar against the US dollar to trade range bound with a bearish bias in the next 2 weeks. And we expect the pair to test its near term support of around 0.5870.
To sum it all up, our technical model still points to near-term risks for US and Japan equities. We would prefer to average in only gradually. We still prefer US growth equities due to their structural earnings growth outlook. And lastly, benchmark allocations to gold and energy-related assets offer hedges in the event of any widespread surprise dislocation arising from geopolitical tension. Thank you, Rajat, for the engaging discussion. Thank you so much for tuning in to this week Through the Noise podcast. Wishing you a good weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.